Yes. So what you're asking me here is basically pre-IPO opportunities. Now, IPO an IPO means when a company goes public on the various exchanges like the NASDAQ, New York Stock Exchange, and so on and so forth. You may have heard of Uber and Airbnb and, Amazon is a publicly traded company, all the big companies practically that you know, but at some point they weren't public yet. And a lot of the big money you hear about early investors in Uber and this and that and the other, they make a ton of money by getting in early. And then when it hits the public, it's already too late. The big money's been made. Not necessarily true, but the big money early will be made right there. So how do you get into that? Well, there's a lot of ways that you can do this. So I get what you're saying. You invest in a pre-IPO company, and then if and when it goes public or gets sold, it's called an exit. That's when you get your returns. So if you invest in a publicly traded company, you're betting on that it will be worth more down the road than it is today. That's what you're doing. Like, okay, I believe in Tesla. They're going to grow. They're going to have more customers. They're going to be in more markets. More people are going to use electric cars. Therefore, I want to invest in them because I feel like this company is going to grow to even greater heights than it is right now. That's the bet that you're making. So whether it's a publicly traded company or if it's a private company that you think can go public down the road, that's just the nature of money. You think something will be worth more tomorrow than it is today. So I hope that answers your question. We were just talking concepts here, but that's pre-IPO companies that then IPO, and then you have IPO, basically public companies, and finding the opportunity there. And I hope that hopefully that's helpful.